Hey there guys, how's it going? Chris Chillingworth here. Today is February the 24th, 2020, and we've seen the FTSE drop 3.3% today. I've had emails, I've had messages, I've seen a ton of stuff written online of traders panicking, investors panicking off the back of this, and I want to record a video today. I'm going to do another FTSE Show tomorrow. Today, the FTSE Show episode 12 was supposed to come out, but I've delayed it a day because I want to get this video out, because look, I want to give some perspective on this issue, because I see a lot of traders and investors panicking over this, and I've even had an email from someone today who's thrown in the towel and they decided to quit trading, and I'm just like, wow, you know, this is kind of, I think some perspective is required here. So I want to show you something very briefly that might just provide that perspective. This is a daily historical record of the open and close prices of the FTSE 100. So here we've got the open prices, on this side we've got the close prices for that day. And this is every day, and then we've got the difference in price movement. So if it's a minus, it means that market went down. If it's a whole number, then it means it went up. And this is the percentage rise or fall for that particular day. And what I've done is I've just used a conditional formatting process on Excel to highlight all of the days where the FTSE fell more than 3%. Okay, and then what I've done is I've essentially spent the last couple of hours of tonight, of this evening, it's Monday the 24th February, just going through those days where the FTSE fell more than 3% and look at the reasons behind it. But not only that, but look at the recovery period from there as well. And I find this sort of thing fascinating. And I feel like it would add some perspective to this, because when the FTSE falls 3.3% like it did today, it really shouldn't bother people as much as it has done. I don't believe so. If you're trading trading a long-term view like I am, you're trading a long-term strategy where we're buying stocks and holding them for anything between 2, 5, 10 years, maybe a lifetime, however long your process is, whatever your financial strategy might be. A 3% drop on the FTSE is literally a drop in the ocean, and I want to show you what I mean by that. So I'm just going to scroll up here. Obviously we don't have today's data on here, it goes up to the 21st of the 2nd, which was the previous last trading day, but obviously if we were to add today, we'd add a new line and it would be minus 3.3%. We know why that happened. It's because of the fears around the coronavirus hitting Italy. There have been a number of deaths. It's clearly spreading across Europe now, and it's caused the stock market to go into a bit of a panic, which is, you know, fair enough. But let's go back. So first thing we come across here is the 2nd of October 2019. Okay, this is American date format, I'm afraid. But it's the 2nd of October 2019, and the FTSE fell 3.2%. And this was due to poor US jobs and manufacturing figures and a World Trade Organization decision paving the way for 7.5 billion US tariffs on EU goods. Whatever the hell that means. It clearly wasn't well received by the stock market, right? So the FTSE fell 3.2% on the 2nd of October 2019. So it's very close to what happened today. And then what I wanted to do is look at, okay, well, how long did it take to recover from that? I.e., how long did it take the FTSE to recover from that? Because today a lot of people have sold out their positions. It's off the back of a 3.3% overall index drop, they've closed a load of their portfolio. And I'm kind of thinking, well, why? Why, just because the price has been quoted at a lower price that day, would you suddenly decide to jack in your entire financial plan of the next 5-10 years and sell it all at the cheapest possible price you could? It seems mental to me. You know, if you had a house that was worth 250,000 and someone one morning knocked on your door and said your house is only worth 100k, would your initial reaction be, oh, well, I better sell it then? Of course not. That would be mental, right? So you wouldn't do that. And the same should be applied to our stocks. But we can see here, 2nd of October 2019, down by 3.2%. For this particular reason, I don't really understand it that well. It was at 7,360 that morning when it opened. And it took until the 4th of November before it closed above that level. 7369. So we're looking at what, 2nd of October to the 4th of November. We're looking at a month. It took a month before the index had risen back to where it was prior to that 3.2% loss. And at that point, we're all back to where we were. And so you just had to wait a month and you would have been back to where you were. But instead, what a lot of investors and traders do is they sell their positions instead of just sitting it out and seeing it through. Let's go back a bit further, because I've done this for a while now, and I've done 2 hours on this. I'm gonna make a proper video out of it. 6th of December 2018, the FTSE dropped 3.1% due to US trade war fears between President Donald Trump and China. And I've got links here to the particular stories just for my own reference. Let's have a look. How long did it take to recover? Well, 6921 was the morning price, and it closed above that at 6942 on the 10th of January. So again, it took about a month from the 6th of December to the 10th of January before the market was back where it was prior to that day's drop. So you just had to wait a month. Let's go back even further. And it's not all the same. So, I'm not just going to keep doing the same thing. But here, 24th of June 2016, so we're all the way back in 2016 now, we lost 3.1% that day. It took 4 days before it closed back higher again. So, and I don't know what the reason was for that. I haven't been able to find that out. I'm sure if I kept digging, I would find the reason why the FTSE fell 3.1% that day. But it clearly didn't last very long before it was back to where it was. Let's keep going. We've got a 3.5% drop on the 20th of January 2016. Oil prices fallen, and there are fears of an economic slowdown. These were the reason for the drop, according to analysts and those in the know in the media. 3.5% drop by that opened that morning at 5876. It closed at 59 just 2 days later. So you had to wait 2 days. Think of all the investors that sold out on that day out of panic, and 2 days later the market closed back above where it was. Mental. This one's a longer one. So the 1st of September 2015, poor China data released prompts fear of a slowdown in the Chinese economy. The FTSE market that day closed down 3%. And it took that long until it had reached above that level. So we opened that morning at 6247. It was at 6298 by the 5th of October. So 1st of September to the 5th of October, just over a month. Here we got a 4.7% drop in the FTSE. On the 24th of August, this was China's stock market falling, prompting global stock market fears. 4 days later, back above. 4 days, all you had to wait. But, I mean, if we're panicking over a 3.3% drop today, well, that day it dropped 4.7% and only took 4 days to recover. Crikey. Let's go back a bit further. There's still, we're going quite far now. They are relatively rare, those 3% drops. My point is that selling at this point is a bad call, I think. 22nd of the 9th, 2011, dropped 4.7%. US central bank warns the economy outlook is gloomy, prompting fears across the stock market. The FTSE was at 5288. It closed at 5303 just, how many days is that? 2 weeks? 14 days? Two trading weeks? Go back a bit further. 5th of September 2011. Stocks fell sharply amid concerns over the Eurozone debt crisis. Took 3 days to recover. 4.5% drop on the 18th of August. World markets in turmoil amid drops in Spain and Italy's index regarding European debt crisis. It took us about just shy of 2 weeks to recover from that. Black Monday, banking shares tumbling. Just a couple of days. Just a couple of days before it recovered. I mean, this is all nuts to me. Let's keep going. So this one's a longer one, right? Here we go. So, the 14th of May 2010, mining stocks take a hit with increased taxes, fears on economic growth across Europe. So the FTSE market fell 3.1% on that day. It was at 5433. It fell to 5262 that day. It actually took quite a long time before it recovered. As you can see now, ignore this one here. It got all the way to here. So what was the price when we got in? It was 5433. And that lasted until 5439 on the 6th of September. So this one lasted from the 14th of May to the 6th of September. 4 months. Biggest one we've seen so far. But still, let's put some perspective on this. So over the last 10 years of doing this, going through this, all of the days where the FTSE had fallen larger than 3% in value, the longest recovery period of that last 10 years is 4 months. So all you got to do is hold for 4 months and the index is back where it was. Do you see my point here? You don't have to wait very long. And that's the worst case scenario so far, 4 months. We've got another 3.1% one here on the 29th of the 6th. It recovered by the 8th of the 7th, so it was a week, just over a week on that one. We've got 26th of the 11th, 2009, a 3.2% drop. Banks under pressure following Walker review. Margin worries for UK supermarkets. It recovered within 2 or 3 weeks, or even a month on that one. And then we've got 3.2, 5.3, 3.1. So it's a bad time for the FTSE in 2009. And this was when the UK banks were being bailed out by the government. So fair enough, right? Let's say this started at 4,018. So when did that recover? By the 2nd of April. So just over a month and a half. Can you believe that? So the FTSE plummeted quite some when the UK banks were being bailed out by the government. I'm sure you can all remember that period of time, right? Even if you weren't trading back then in 2009, we'll all remember that period where the markets were in turmoil because of this. And they had recovered by the 4th of April when this was going on in end of Feb. So it was just a couple of months. And the markets were back up to where they were. Now, granted, they go down, they go up, and all that kind of stuff. But my point is, even these events here didn't really do enough. And so that's the perspective I'm asking people to kind of look at here, is that this is not a reason to be ditching all your portfolio, to be selling all your shares. You know, if the FTSE drops 10%, fine. Like, okay, well, that's a big drop. But a 3.3%, we've seen them loads. We see them all the time. There's always these stupid little reasons for why this is happening. This is all the 2008 financial crisis. All of these drops in back then. I mean, we're looking at 5.4 for the. I mean, this is a big one. This is a big one. So this takes a while to recover from, granted. But this is the 2008 subprime mortgage crisis. And it had largely pretty much recovered. I think it took about 2 years to properly recover from that. So, look, we've got 8.8% drops, 7.2, 5.3, far bigger than what we saw today. And so far we've just had 1 day of this. This is a continued droppage of value. Right, all the way from sort of 5.1 to 3.9. So quite hefty drop over the period of about a month in 2008. And it took about 2 years to recover. So even then, if you've got a long-term view as an investor trader, if you're saying, I'm going to buy and hold these shares for 5 years, then do that. Because the markets recover. And in the worst case scenarios, in the worst periods of the last 20 years or so, it's only taken 2 years for the markets to recover back to where they were. And if you're buying whilst the markets are down at 3.8 or 4, if you're buying shares, then you're going to make a ton of money as on the way back up. You see what I'm saying here? So these are great opportunities for us to make money. And something else I want to briefly show you here, this is just one example. This is Diploma PLC. And this is the period of the 2008 subprime mortgage crisis. This is when the share price fell from £2.30 down to 90 pence a share, essentially. And it took, a good 6 months for that to happen. But this was the subprime mortgage crisis, what we just looked at on the FTSE. But this is a particular stock. This is Diploma. And this is the share price going down, right? And, this fell quite some. We're talking about probably about 50-60% drop here in share price value, right? Here's what I want to show you. Again, perspective. So for most investors at this period of time, this is the reason why those who are weak and really don't believe in their systems are bailing out of these particular markets. But if you just buy and hold, it doesn't take long to recover, first of all. So where the price began to fall in October 2007, it was back by June 2010. So 2.5 years, and it was back to this peak point just prior to the 2008 crisis. I'll call it a crisis. It was a crisis for many people. But if we move on, let's say 10 years, 12 years, you can hardly even tell that there was a 60% drop. Because holding on to this stock for another 12 years means that, okay, your position, if you bought at the worst possible time, in theory, would have been £2.30 a share. It's now worth nearly 21. You can see the drop in Diploma today following the 3.3% FTSE drop. It's nothing. It's tiny. So all those who are abandoning their trading, quitting trading altogether, you're doing something seriously wrong. You either are too tight in, your stop losses are far too tight, you're taking too much risk on a trade, or your mindset's just wrong. And really you need to be looking at this as a longer term process. I genuinely believe that if you're a beginner wanting to get ahead, wanting to make money from the financial markets, the long-term view is your best way of doing it because it takes so much pressure off. A 3.3% drop on the FTSE today is nothing. I logged in, I saw the prices were down, I knew exactly why that was. It's the coronavirus outbreaking into Italy. It's probably going to spread across Europe into the UK. We'll probably see another losing day when that happens. It could be the start of a stock market crash, perhaps. But my point is perspective, the wider perspective. Even if there is a stock market crash, the market will recover. And the beauty of a stock market crash is we can buy on the way back up. We can buy on the way back up, guys. You will make not only will the value of your positions return back to where they were pre-crash, but you'll make a ton of money getting there. You will make a ton of money on the interim. So that by the time those original positions get back to where they were, you have made a small fortune on the side as well. And so these are not reasons for us to suddenly sell our portfolio and quit trading. This is not reason to be jumping on the email and sending me emails panicking, oh my God, what's happening? It's kind of mental. And I just wanted to, I kind of get it. I get it from some people because I've been there before when I first started trading. I had the wrong kind of mindset. I was too focused down on the day-to-day. I was too worried about trying to make money in the next 3 months rather than trying to look at the long-term view. And when you need to make money, when you need this to work in the next few months because you want to make money, when I see traders saying, I want to quit my job and do this for a living, I say to them, no, because if you need the money, when an event like this happens, it will be too emotionally traumatic. And when you don't need to make the money and you can sit and wait and allow your funds to grow and allow your capital to grow over 10 years, 20 years, not only can you make a fortune, but events like this, these 3% drops, they really don't mean much. You just shrug them off and the next day, it'll recover over the next month, I expect. Who knows? It could be the start of a stock market crash. It might take 5 years to recover. But those 5 years will be spent by me buying more shares as we recover. Hope that makes some sense. Hope that adds some perspective to the day. Let me know what you think. There's a comment section underneath this video. People really use it. So drop me a line. Let me know what you think and I'll respond to you. Otherwise, you can email me at chris@thecleantrader.com. So it's chris@thecleantrader.com. Feel free to drop me an email if you've got more than, just a few lines to say. But I'd love to hear from you and I'd love to hear what you say and think. Thank you very much for watching. Like I say, I hope it's added some value and I'll see you guys in the next video. Cheers.